Welcome back to another weekly episode. So, before I begin, nothing I say on this channel should be taken as investment or trading advice. Please consult your SEBI registered investment advisor or research analyst. Second, I do run a community on this channel. It has nothing to do with futures and options trading, nothing about BTST, nothing about short term trading, and nothing about option selling as an income generation idea. So let us begin with what happened. First, how do you read this presentation? This is important. Please pay attention. You will find near term participation and core trend participation. This is something I'll use throughout this presentation. Near term participation has everything to do with day to day movement, at the most 1 week kind of movement. That is Monday, 3rd August to Friday, that is today. The core trend participation has everything to do with little medium term. Medium term, I would define it as an amalgamation of 3 to 6 months, that is with respect to the trend. So that is how you need to read this. When I say leading, it means it is strong over near term and core trend is also strong, that is long term. When I say weakening, it means that in the long run, it is a bit stronger, but it is weak on the short term. Improving means soft core, which is the long term trend is just about getting there, but near term is very strong. Lagging means it is soft on both, which is near term trend is not there and core trend, which is long term trend, is not there. I hope this part is clear. So let us now look at what happened during the week. There are four core numbers that you have to pay attention to. 36. Remember how many groups I told you that I'm covering in the market? I'm covering 56 main segments, main sectors, that is. So 36 were leading the market. If you've been watching my videos regularly over the last 1 month, you would now know which pockets were currently leading in the market. So that number remains the same. The lagging portion of the market, that is, some sectors did have deterioration in price and trend structure. So that has moved from 3 to 7. That is from Monday to Friday. Remember, this is data from Monday to Friday. The number of sectors that are essentially strong on higher time frame charts, about 2 or 3 lost leadership on higher time frame charts. That is mainly because of how earnings impacted the specific stocks in those sectors, because they had quite a high weightage in those sectors name. So I won't read too much into this number. The impulse number I'll explain once that particular chart comes out. So if you look at what has happened in the week gone by, that is from 3rd August to Friday, that is today, it appears as though nothing has happened. Market has remained flat. There was a lot of things about the new closing system that was catching the eye, a lot of discussion around that I think over a period of time will settle down as liquidity comes in. For those of you who were in the market when the pre-open session was also introduced, you would remember how some heavyweight stocks used to move 10, 15, 20% in a matter of 5 minutes in the pre-open. And then, of course, it would settle down as the markets would open. Why this is gaining more attention? Because in the field of technical analysis, the closing price is the most important price. That is why you're seeing so much of discussion around it, and rightly so, because it does hamper charts. So what I've done in this week is not rely much on sector charts, and wherever futures charts were available, I was tracking those charts just to see what kind of candles were getting formed. But as of Friday, I have seen over Wednesday, Thursday, the CAS system, that is the new closing system, has started to settle down. So look at what this particular number is. The green part is the leading sectors. The yellow part is the weakening ones. The orange one is the improving one, and the red one is the lagging one. So from Monday to Friday, you will see the leadership is intact. All right, leadership has not changed at all. What is slightly deteriorated is that the number of sectors that were lagging, that actually jumped to about 7. I still won't read a lot into this because the result season is going on and sometimes these things happen. I'm always bothered about leadership. I do see that the leadership remains intact, and for me, this is the most positive sign for this particular week. Now, the next question is, did the breadth improve this week? So you got to understand what has happened in this particular week. If you look at this week, healthcare and pharma was the strongest pocket, with the remark that I made that this is consensus. So whenever things get in a consensus category, what actually happens is that it goes into a sideways kind of consolidation. So which sectors were earlier strong that were heading into the weaker zone? But I was again and again repeating, it is not weak, because on higher time frame they're still strong. PSU bank, metal, EV, then power segment, and capital market and defense. If you now look at it, what has happened this week, I'll come to that in a bit, but there is rotation happening. So now the pharma, healthcare, hospital consensus, it will take time to cool off. That is why you are seeing that in the near term participation, some sectors are heading lower. Now, these are those sectors that were mainly strong and were consensus kind of candidates, which is pharma, hospital, healthcare, mid small cap healthcare. And you've seen new kind of sectors that were consolidating, taking the market higher, which is auto, EV, transport, manufacturing, chemical, and metal. Out of that, I would tell you in the very near term, auto and EV is also getting a consensus kind of a candidate. And then you'll start seeing defense and capital market, those kind of sectors starting to chip in. So this is the kind of rotation that is happening in the market. Yes, in the very short term, you are seeing that the leader pockets are consolidating, so it gives you appearance that the breadth has not improved. But if you see relatively, breadth has remained stable while other sectors have started chipping in. This is a phenomenal sign for the market, let me tell you. Don't make a mistake of reading this as, the older sectors are now falling. They are not falling, they're just consolidating. So now if you look at it again, this is the same chart. I've just represented in a different manner. So what is now happening in the market is that the leading segments of the market continue to remain the same. This is a point that I just reiterated. What was heartening for me to see is what happened in the weakening quadrant, because I don't want many sectors going into the weakening quadrant when it comes to the sector map. So from 6 last week, it has now narrowed down to 3. Now, why it has narrowed down to 3? Because defense, capital goods, and some bit of energy also improved this week. Remember where metal was 2 weeks back, now defense, capital market, and some bit of power sector is also in that segment. That is something that you have to pay attention, because a strong sector, once when it pulls back, it comes back, takes support at 50 DMA, forms a base, and then moves up. Look at what has happened in metals. The same thing currently is going on in the defense sector, and capital market and power sector will also do the same. It can fail. It is not that it cannot fail, but this is a template that you always have to kind of repeat again and again when it comes to your analysis when you're doing in the market. So now, for the week, what happened? Was it a defensive kind of a market or a risk on kind of a market? See, you have to understand this week, although no major movement happened, the news flow was around the new closing system. It was a risk on kind of a market. Why? Because look at which sectors gave some ground away. Healthcare, staples, technology, all lost in the near term. Now, what gained? It is metals, capital goods, auto, defense, cement. This is what continued to gain. So, marginally, yes, it was a risk on kind of a market, but because it is not a full fledged risk on market, you're not seeing major movement happening in the market. This is a distinction you have to understand. Otherwise, you will label the market as slow and sluggish, but nothing is happening. In fact, the market is slow, sluggish, but very constructive. So this particular week, what was the main sectors that got bought? It was capital goods, it was defense, it was tourism. But the biggest near-term gains came in metals, PSU bank, defense, and cement. And out of these 4 pockets, 3 pockets I have alerted over the last 3 weeks that just because these sectors are now near and below 50 DMA does not mean they are weak. They have exceptionally strong charts on higher time frame chart. Now, when it comes to a little longer term trend kind of assertion of the trend, again, it was these pockets. Out of that, I will only take into consideration PSU bank, metal, and defense sector. It's not, and MNC also. I would still leave tourism out of it because tourism is currently prone to a lot of global news flow. And your job as an investor or a trader in the market is to minimize the volatility that you can see in your own account. So don't go by themes that are facing a lot of global news flow with respect to crude commodity prices, because this is a sector that directly gets impacted. Now, what got sold? Housing finance, PSUs, energy, insurance, mid small cap technology, and those kind of sectors. Also, the near term losses were mainly seen in pharma, healthcare, insurance, consumer durables. All these were pockets that were leading. Housing finance was also leading, mind you. So, what is happening is that now the stronger pockets in the last 2 odd weeks that were becoming a consensus are now pulling back. That is what happens in the market always. That is why you should not always chase what is happening in the near term. Just have a bird's eye view about the market overall. Go to higher time frame charts like monthly, weekly, see what is happening, what can improve, what is strong, and what can improve further. Keeping risk reward consideration as a primary criteria is what will help you get into these sectors early. Always remember this. Now let me explain the pivot point, that the momentum impulse. See, what happens is, I'll just explain this particular chart in a very simple way so that you can understand. Just for once, ignore what is written here. By the way, a lot of you ask me how these presentations are made. Always remember, I use AI agents to make presentations, but AI agent will not give you these presentations unless and until you give them proper data. And data is nothing but an analysis framework. Unless and until you have a framework that you decide for the way you look at the market, you'll never be able to give the right prompts and the right data for an AI tool to make presentation. AI, as it is said on internet, is not about just writing to an AI agent, give me a presentation about what happened in the market this week. You will get some vague data which won't be accurate. Data you have to give, interpretation you have to give. AI just makes it in a more friendly format for you to understand. I hope this point is also addressed. So now let me explain what happened. I'll give you a picture of what this momentum impulse is. So let's say you have a reading of 7.2, what it means. Forget that for the time being. See, what happens is this is calculated with what kind of sectors are moving in the market. Always remember, I give more importance to high beta sectors. High beta sectors are the sectors that set the tone for the entire market. A market that is being led by pharma, healthcare, FMCG, consumer durables is a market where momentum won't be there. A market that is being led by autos, metals, banks is where momentum will be there, and that is what you're seeing here. Auto continued to strengthen, defense started moving up, metal started moving up. That is why this number started improving. Now, why do you have a 4.6, such low number here? Primarily, number one, because I'm making this video while the market is on. So the entire data I don't have. So take this 4.6 as an asterisk. Second, today is also a day where a lot of pullback is happening. Some key sectors are also not working. Banking sector is also not working that much. That is why this is half baked data. I would tell you by the end of the day, when I compile the data, this number would be around 8.3 or 8.5. So the entire week was good. Though breadth wise we are stagnant, not much movement has happened in indices, but underneath there is some sort of a risk kind of a tone in the market. That is a risk on. I would tell you it's a risk on phase in the market, but the momentum is not there. That is the problem. So now let us zoom out and see the same chart over the last 40 days. What has happened over the last 40 days? If you see, the number of sectors that are leading the market has actually strengthened. If you go and watch all of my videos, this is the message I have given, that yes, movement is not there at index level, but the market is broadening. There is a silent bull market going on in India. But the focus these days is so much on AI and those kind of gains that people are seeing there, that they are forgetting that we have a diversified story. Look at the earnings results that are coming out. I'll put that slide also out. There are plenty of opportunities that are there in our market as well. With the data center and AI, let's say people have craze about this. There are some 4 stocks in our market that represent AI and data center theme. They have gone up 80 to 120%. So if you pay attention, there are opportunities. That is always my message. So the number of stocks, the number of sectors that were earlier a combination of weakening, lagging, you know, uh, that number has also, if you see, shrunk here. So it just tells you that in the month of July, that is 1st of July, the combination of sectors that was forming the weakening, improving, and lagging quadrant was way higher. Always look at what is happening in terms of the strength metrics. 15 July, 37 sectors were contributing. 7th August, 36 are contributing. We haven't fallen much. So much of negative news flow. So you always have to take that into consideration when you're analyzing the market. Now let us move to the next segment, that is banks and the importance of banks in today's market. So you got to understand that Bank Nifty is where the momentum actually comes from when it comes to our markets. Whenever you will see banks start to do well, you will see high beta sectors and stocks in general start to perform very well. It's mainly because banks and Bank Nifty in general remains the heart of our market. And that is essentially not doing that well. Mainly the private part of it, and mainly couple of banks in the private sector space that are just not doing well. Quite recently, one had an AGM, and I was, as an investor, or call me a long-term trader, I was extremely disappointed with what I was seeing in the AGM. The body language of some of the key personals, it got to be better. I'm also happy that investors demanded return, because at the end of the day, the job of the management is to deliver return. A management that cannot generate return for a shareholder should not be at the helm of the company. That is just my firm belief. And you also have to understand that a couple of private sector banks are actually holding the entire Bank Nifty index at large. I would tell you the structure of Bank Nifty index is fantastic. But that fantastic part of Bank Nifty structure is essentially missing a very important component, which is momentum. If momentum does not come back, eventually what you start to see is at higher levels, price will stall and then again selling appears. It also has to do with what is happening over with the FII front. See, AI theme has again started working. And this is the point I was discussing in one of my videos with you, that Korea, S&P 500, Nasdaq, everything is now corrected. We have nothing here that would prompt FIIs to bring a lot of money. They are again going to go back to the theme. And look what has happened to S&P 500 and Nasdaq. Korea, of course, has not stabilized that well, but over time, that is where investors interested, and that is where returns are, that is where policies are in favor. The second part that I was coming to is that we have just stalled when it comes to attracting FII and FDI capital in India. We need this. The whole idea that we are going to be a developing country one day, we have the demographic dividend, just because of that somebody is going to bring the money today, that idea will not work because we have competition from so many countries. A lot of investors and traders today are chasing short-term returns, and India is not offering short-term return. If someone will tell me, is India going to deliver huge short-term return, I would probably tell you no. But long-term, India is a fantastic diversified stock market that is there, one of the best in the world. I would tell you, there's no other diversified stock market so liquid that is there in the world. It is just that we don't know the art of attracting money. Somehow we make policies, we make media releases, statements that continues to drive capital away. Yes, FII money is coming through different route, but again, the whole essence of capital market is to aid the economy to do well and to keep moving forward. Capital market is a great tool, and unfortunately we are not doing that, and Bank Nifty is actually reflecting that. So within this space, NBFCs, yes, is doing well over the near term, but if you look at private sector banks, that is what is dragging the entire Bank Nifty down, as in there's no momentum. And second, it is also a keeping lid on other high beta pockets. Whenever Bank Nifty to do well, you will see how quickly the entire sentiment changes in the market. And that is what stock market is all about. It is about perception, it is about sentiment, and it is high time people recognize this. Else, this mediocre kind of performance will continue, and it will keep getting difficult to identify stocks from the haystack that we already have. We need policies, and we need them quickly. In the private bank segment, we need more accountability. We need more strategies for companies to grow at the ground level so that the margins expand and ultimately the stocks do well, because that is when investors benefit. There is no point of opening up thousands and thousands of branches if those branches are not contributing to shareholder return. All right. I would be happy if the entire management would expand the branches and whatever they want to do, and not take salaries, not take hefty bonuses. Then I'm okay. Shareholders are essentially the ones who are offering capital for things to happen in a company. And they are not offering capital so that a company does not deliver return for 10 years, 7 years, 8 years, 5 years, and still continue to say we are doing our best. That is not enough. I wouldn't have said this had a couple of stocks not had so much of high weight in Bank Nifty. But ultimately, it is how it is. If you talk to any long term market participant, he will tell you how important Bank Nifty is when it comes to sentiment and overall the high beta pockets in the market. So let us now come to the earnings. About 1073 companies have declared earnings now. I only take the liquid ones, and the results have been fantastic. I would tell you fantastic because there was a pessimism around this particular quarter, and whoever is coming out and saying that this was going to be a good quarter, I think they're just lying, because most of the consensus reports were just not expecting the kind of quarter we have had. So 18% roughly median growth, 17% revenue growth, 25% PAT growth, 23% EPS growth, and 61% companies have had profit growth on back of margin expansion. This is just really strong delivery by corporate India in this particular quarter. Again, we are neither advertising this nor we have the right policies to attract investors. A word on gold and silver. A lot of buzz in media now around gold and silver. I would only tell you one thing: both of these assets are currently building a base. Look at where price is with respect to 200-day moving average. And yes, 200-day moving average works irrespective of what anyone says out there. The silver boom that happened above 200 DMA. The collapse happened below 200 DMA. Never let anybody tell you that 200 DMA does not work. It is a sentiment indicator. It is not an indicator to do a buy sell kind of approach. All right. So good base building is going on. When price is below 200 DMA, you will always see more fluctuation, more volatility. Be patient. Now, the global market remains fine. Global market is great. Money is again flowing in the AI theme. FIIs are not going to come back to India so soon. And of course, the points that I've spoken, that we need more serious look into our policies. So what to do actually? Remember one thing, the market is getting really strong with each passing week. It feels slow because high beta. More importantly, couple of important pockets in the market are not showing momentum. Bank Nifty moves up 4% in a week. You look what will happen in the next 20 days. All right. Just mark my words. The day Bank Nifty starts moving up and on a week basis, it gives you 3.54% close. Look at the subsequent 4-5 weeks in the market. You'll see how quickly things start doing well, momentum wise. All right. Do nothing in the market over short term. Means don't do entry today, next week does not work, exit, then Monday again you get in, Wednesday exit. Don't do that. Transaction costs are so high that it is just going to eat up your account. Rather, I would tell you, a lot of people are not losing money because their strategies are wrong. They are actually losing money because transaction costs are so high. So just be careful. Before I end this video, one psychological point I would like to tell you: limit your time on the internet. Whether it is any social media platform, you will always see short term is blown out of proportion. If you don't believe me, go back to March, April, May, June. Look at the headlines. Look at where a lot of stocks in the market are today. They are comfortably 40 to 60% higher. And you can go back and check my remarks also in March, April, May, June. All right. So comment section is open, guys. Have a great weekend ahead. Take care and be safe.